All right, so Chapter 6, inventories. And you thought accounting just had one set of rules and we did it one way, right? Inventories is like, how many different ways can we calculate inventory? There's actually more than in here, but this is enough to get started, right? So they talk about classifying inventories, and they start out first by saying, again, merchandising companies, which we've been talking about, they only keep track of one inventory. When they buy something, they know what they paid for it, and they go through and they record that as a debit to their inventory, merchandising inventory. When you get into your 202, you're going to learn about something called manufacturing companies. They actually have 3 inventories. They have to make things, right? So they have to get the raw materials and order them, so they have a materials inventory. And then while they're working on the stuff and going through and turning it from a raw material into a product, it's in process, so they keep track of the cost and work in process inventory. And then when it's done and it's finished, but not yet sold, it sits waiting to be sold, it's in finished goods inventory. So the finished goods inventory in a manufacturing company is similar to the merchandising account inventory for a merchandising company, but they have to worry about the direct materials or the raw materials and have to worry about the work in process. So don't have to worry about that here in this class. That's just something to look forward to when you get to 202.
They actually, that's in the chapter.
Yeah, but you're going to actually spend several chapters learning how to do it. But you're not going to worry about that here. You just need to know the definitions that they're there. We're just going to focus on the merchandising, okay? And so they go over and they start talking about how you figure out inventory quantities. They talk on 261. They say even though you have a perpetual inventory, because we know that gives you the updates and everything of how much your inventory is at any day of the month, you still need to go through and count your inventory on a periodic basis. Obviously, if you're doing periodic inventory, you got to count your inventory. You can't come up with a balance of what your ending inventory is and what your cost of goods sold is. So that's kind of given. However, in perpetual, you still need to go through and you need to do a count because you want to check it at some point and try to figure out how much you have in the inventory versus how much you have in your warehouse, right? And so by doing that, that's going to help you catch any mistakes or make adjustments. And they actually talk about when you take a physical inventory, going through and figuring out how you make the adjustment. If you're doing perpetual, all you're going to do is look and see what your difference is. And you're going to, if you need to add to inventory, you're going to debit inventory and credit cost of goods sold. If you have too much inventory, you're going to credit inventory to reduce it and debit cost of goods sold. Hopefully, if you're doing perpetual, when you count it in the warehouse and do a physical count, it's not going to be much different than your books. If it is, you need to investigate the difference, right, to make sure there's not waste or theft or fraud or something like that going on. And I got to say, counting inventory, the physical inventory, any of you ever done inventory at your work? Okay, it's a lot of work, but it's kind of entertaining. As auditors, we always like that because, you know, auditors are typically working indoors. But when you did inventory, you often got to go out and be in the warehouses or drive around and see different places. And it's like a field trip. And so counting inventory is interesting. You always want to go out and physically count the number of items that are said that are on the books. And then not only do you count the number of items and physically make sure they're there, but then we'd also go through and then we would check to see what the prices were that were listed to make sure that people hadn't gone through and used a different price. Because one of the ways that you can create fraud is not just counting the items wrong, but also pricing them wrong. So that was something we'd always check at the end of every accounting period whenever we were doing an audit on a company, was verify physical count and then verify the pricing. So it's a big part, because again, as we said, this has a big impact upon your balance sheet and on your income statement. So you always want to go through and count things. They talk about what you do with goods that are in transit, you know, that are moving back and forth. That can be kind of a problem sometimes. Who do they belong to? And so they have this term called free on board, which is kind of different. FOB, free on board. And so what that means is basically who's paying the freight. And so they have FOB shipping point, and they have FOB destination. And what that means is if I'm a seller and I'm going to sell my product to a company and it's going to be shipped there, if I sell it FOB shipping point, that means that I basically, once it gets to the shipping company, say a trucking company is going to come to my loading dock and load it up and then take it to the customer, I'm only responsible for it up to the shipping point. In other words, once it gets on that truck and leaves, it's no longer my inventory. It becomes the inventory of the person that's receiving it. It's inventory in transit. And that's something you always want to count, watch closely at the end of the period, accounting period, is to make sure if there's inventory that's going back and forth, you know who it belongs to. Because it can either get missed or double counted sometimes. Okay? So if it's to the point where I put it on the truck and it's FOB shipping point, once it's gone, at that point, first off, I actually have a sale because the sale's happened. So I'm taking it out of inventory and I'm recording it into my sale. Also, the responsibility is no longer mine. So if that truck has a wreck and there's a damage to the merchandise, it's not my problem, it's the buyer's problem. Okay? The other FOB is FOB destination. That's where, as a seller, I'm responsible for it until it actually gets to the destination. So the transfer doesn't occur until the truck basically arrives at the customer who bought it and unloads it there. So anytime there's a problem in transit, that's still going to be my problem. If the truck has an accident and the merchandise is destroyed, that's my loss. It also means it's my inventory until it's actually delivered. So if I have, at the end of the year, on December 30th, I put a load of merchandise that I've sold to a customer in a truck and I'm sending it to FOB destination, and it doesn't get there till January 3rd, I include that in my December 31st inventory because technically I still own it. Even though it's not physically on my property, it's still my responsibility. I have legal ownership until it's actually reaches its destination.
But you do count it in your inventory.
I would count it in my inventory. So if it was something, like I said, if I shipped it out I put it on the truck and it went out on the 30th, if it was FOB shipping point, I'm done, it's not in my inventory. But if it's FOB destination, I'm basically saying it's mine until it gets there. So even though it's in a truck somewhere driving around, and who knows where on New Year's Eve, right? It's driving around, it's my inventory, so I would count it in my inventory.
The homework question was saying put a 0 there for not counting it in inventory.
Ah, well, that homework question was incorrect if that was the case. So,
and that's
yeah.
what we were discussing.
Okay, well, let me know. I'll look at that and see. Because if it's something that we shipped and its destination, it's not till it gets there. So if it got there after December, or if it got there after December 31st, then it's going to be part of our inventory.
Is one more common than the other? Or it kind of depends?
Shipping point.
Yeah.
Yeah, shipping point's more common because typically the buyer pays the freight. But it's completely dependent upon how you negotiate. I mean, if you're a seller, you might offer to pay for the freight in order to get it's kind of a discount. It encourages people to buy from you. So it's kind of the same thing when we go on the internet.
Like
If they offer free shipping,
Okay.
if they offer you free shipping, oh, I'll buy some more of that, right? Because you're going to save yourself some money.
Like Amazon Prime.
Amazon Prime, yeah,
Now,
exactly.
question about the FOB destination. If you sold it and you sold it in December, but it didn't get there until
January 3rd.
January 3rd,
Yep.
you count the inventory. Would you count the fees also for the freight out or no?
Because the year end was December 31st.
Oh,
You
okay,
don't count
so
it until January.
so if December 30th I shipped it and it doesn't get there till January 2nd, and I shipped it FOB destination on the seller, it's still my inventory. The question is, when do I pick up the freight cost?
Until January, correct?
That's a good question. I'm probably not going to get billed until January. So since I don't get billed till January, that's when it actually the sale happened. The sale occurred in January, so I would want to put the selling cost
No, but it
with the
wasn't
sale in
asking about
January.
bill. The question was whether it was counted in the inventory or not.
It would be in the inventory. But yeah, I put the sale in January because the,
Yeah, I know,
the
it's
selling
two
expense is in
different
January.
questions.
Okay. Oh, maybe
You guys are getting way beyond introductory accounting in your questions. Those are good questions. Okay, so they talk a little bit about that on goods in transit. They also talk about consigned goods at the top of 263. Consigned goods are where you have merchandise in your showroom or in your warehouse or wherever, but you don't own it. You never took legal ownership of it. You basically have agreed to place it there for somebody else, and then if you sell it, you'll collect the money, and then you'll send them the money, and you'll take a fee. All right. So consignment inventory is not part of your inventory. It's whoever the person was that had you put it on your showroom floor for them. That's going to be their inventory. So that'd be another place, if you're a company who has consignment inventory, you need to include that in your inventory, even though it's not physically on your premises. So consignment inventory belongs not to the person where it's located, the company it's located, but to the company who actually placed it on consignment.
And that was my frustration, is I know a lot of this stuff from business, and the book was telling me I was wrong.
That can be annoying. Okay, over on page 264, now we get into the cost flow methods, okay? And they talk about there's different ways we can calculate. First off, how do we figure out, if we're going through and we're going to sell some stuff, right? odds are we're not going to buy it all at one time at the beginning of the year. We're going to buy it during the year, do different multiple purchases, because we sell things, we need to buy more to replace it in our inventory. The problem with that is when we have multiple purchases, we often pay multiple prices. So once you have a bunch of purchases and are going through this and they're all kind of mixed up, when you sell it, what cost do you take out? What value do you credit to your inventory? And that's what we have to talk about with what they call the cost flow assumption. Now, if you're using something called specific identification, that's not a problem. Every item that comes in, you keep track of separately and you know what you paid for it. And so when you sell that item, you look at what you paid for that item and you use that as your cost. So that would be something you would use for like very expensive or unique items. If I'm a jewelry store and I deal in one-of-a-kind jewelry, I'm going to know when I sell this $10,000 necklace what I paid for it. So I'm going to take that and put it in my cost of goods sold. If I sell this $15,000 pearl pendant, I know what I paid for that because it's different. If I am a car dealer and I deal in exotic cars, I'm going to know what I paid for each car and I'm going to take that cost out when I sell that car. So specific identification is the most accurate way to kind of keep track of what your costs are. It also allows you to go through and maybe manipulate your income a little bit because you could choose if you wanted high income to sell your items that are going to give you high income. So you'd sell things with low cost because that would make your income higher. If I wanted low income, I'd sell things that had a high cost because the high cost would make my income lower. So you can play the game a little bit there. But typically, you're not going to do that for a high volume items because keeping track, if you're Walmart, keeping track of how much you paid for every item on your shelves is just going to drive you crazy. You just couldn't do that.
And they buy in bulk anyway.
And they buy in big bulk anyhow, at different times. So specific identification doesn't get used all that often unless it's expensive, high-end, unique types of items. Typically what we use is something called either FIFO, LIFO, or average cost, because what we do there is we're going to take a look at how the items came in, and then we're going to use the cost associated with when those items came in. So those are what we're going to use. So let's talk about what those terms mean, LIFO, FIFO, and average cost, because you're going to spend a lot of time discussing those. FIFO, F-I, FIFO. I always want to say FIFO phone, right? FIFO. It sounds like a giant. FIFO sounds like, that stands for first in, first out. FIFO, first in, first out. What does that mean? The first ones we bought are the first ones that we sell. In other words, we sell the oldest stuff first, right? Oldest first. Oldest sold first. And if you think about it, that kind of makes sense. If you're a bakery, what do you want to sell? The stuff you baked today or the stuff you baked yesterday? You want to sell the stuff that you baked yesterday because if you keep it around another day or two, it's going to be stale and nobody's going to want it, right? So you're always trying to sell your old stuff first because that's kind of the normal flow, physical flow of the goods through the company. You try to sell your old things first before they become old or obsolete or stale or spoil, right? So FIFO kind of makes sense. Then you have something called LIFO. Last in, first out. What that means is the last things that you purchased are what you sell first. Which doesn't make sense, but I could see that, okay? Or in other words, you're saying the newest items are sold first. Which means, what do you keep in your inventory? The old things, right? So with LIFO, you keep the old things. Now, why can you do this? I mean, why wouldn't you just use FIFO? The reality is about half the companies use FIFO. About 25% of companies use LIFO, and there's some reasons we get into for income tax purposes and stuff, but about 25% use LIFO, and about 25% use average cost. So the majority of companies use FIFO. It makes sense, it's easier, and there's some accounting reasons why they use that. But the bottom line is, you're going to probably see a little bit of all of this. It's not required that you pick a method that reflects what the flow of your goods are through your store. You're allowed to pick either FIFO or LIFO, or average cost. Okay? Let's just talk about the average cost. So what's average cost?
Is how many items you have added up and then divided by
You
the
take
number.
all the items you bought during the period, you divide the dollars you spent for them by the amount, the number that you bought, and you find what your average cost was. It's what it says. It's a split between the two. It's kind of, LIFO and FIFO both have advantages. Average cost is kind of a blended, okay? These are the three methodologies that you're typically going to see. Now, here's the thing. Can I just pick one method one year and another method another year? No. For consistency's sake, I'm required to go through and stick with one method. So if I pick one of these, I got to use it from year to year to year. I can change, but I better have a good reason, and it's a lot of work. So typically, companies pick one method, they just stick with it.
Well, the book actually talked about that there was a company that would take one particular type of stuff they sold and do FIFO, and another stuff that they sold, I think it was like based on market value or something like that, and do LIFO, and they said that they could split it.
You can split it by different categories of products.
Okay.
So I can go through and I can use LIFO for, say I'm Sears, and I have auto parts, I have appliances, and I have clothes. I can use different methods for different product categories.
Okay.
But typically I can't change my appliances and use LIFO one year and then FIFO the next year on that item.
Okay.
Okay, so you can use
Good.
that.
Okay, good. Okay.
So how do these costs work? Well, we're going to go through some examples. And again, it depends upon whether we're doing perpetual or periodic, because we can use periodic FIFO or perpetual FIFO. We can use periodic LIFO or perpetual LIFO, and we can even use perpetual average cost or periodic average cost. So let's go through the periodic ones first, because those are a little easier. They're more likely to be used, to be perfectly honest, and then we will walk through the perpetual ones. So we're going to go through and we're going to start with the first one over on page 266, which is FIFO. Now, the first thing you need to know before you can do this is you need to know what your actual transactions were during the period, okay? So we're going to go through and they're going to give us, what do we have here? Okay, they're going to tell us on January 1st, okay, so January 1, we had beginning inventory, and we had number of units in beginning inventory. We did a count, I guess. We had 100 units. And our unit cost, the cost per unit, was $10. Which means that our total cost was $1,000, okay? So that's what I had in my beginning inventory. And I'm doing, again, periodic. Then they go through and they tell us what our purchases were. So on April 15th, we had a purchase. We bought 200 units at $11. So we paid $2,200 for those units. And then on August 24th, we don't buy a lot of inventory, do we? Must be big units. We had another purchase. And then we went through and we bought 300 units and we paid $12. And so that worked out to be $3,600 we paid for that purchase. And then finally on November the 27th, we had a big purchase for Christmas. About 400 units, $13 what we paid for each one of those, and the total was $5,200. So if we add all this up, we see that we had 1,000 units that we purchased, and the amount that we paid for all of those was $12,000. Okay? So that's what's given to us. Now the question is, how do we go through and figure out what our inventory valuation is? They tell us we went through and we did an inventory count at the end of the year, and we had 450 units. So ending inventory, physical count, equal 450 units. So the question is, what are the dollar values associated with those 450 units? Is it $10, $11, $12, $13? Okay? If we're doing specific identification, we'd kept track which ones we sold. So we might have, 10 out of there, and 100 out of there, and 300 out of there, and the rest out of there. But we're not doing specific identification. So we're going to do FIFO first. First in, first out. So what we're going to go through and do, FIFO says that which ones did we sell first? The first ones in were the first ones out, right? So the first ones that were in, the old ones we sold.
Right.
Which means which ones do we have left?
The later ones.
The last ones. And how many do we have?
450.
450. So what we're going to do is we're going to start with the last ones, and we're going to basically work our way up until we get to 450. We're going to create layers, if you will, of our valuation of our inventory. So what we're going to do is we're going to say, well, if FIFO, the first ones in were the ones that we sold, okay, then the last ones were the ones that are left over. So we start with the 400. So we have on November 27th, we had 400 at 13, okay? So that equals 5,200. But that didn't get me my 450, right? How many more do I need?
50.
I need another 50. So I'm going to go up and take 50 out of this, and I'm going to say from August 24th, I took 50 out of here, and those 50 cost me 12. So if I extend that out, that gives me 600. So now I have my 450 units, right? And valuing those at the different layers that were left over in the inventory, that gives me a value of $5,800. So that's my ending inventory. That's my number I have for ending inventory. But now remember, I'm doing periodic, so I've got to go through and find what? My cost of goods sold, right? So what I've got to do is I've got to go through and figure out, well, how much did I sell? Well, how much did I have available? I had $12,000 available, right? Because I had all these available, these prices. So I had a total of goods available for sale, right? $12,000. Everybody see where I got that? I just figured out how much the dollar value was of all those 1,000 units I had. And I didn't have that many at the end. How many did I have?
5,800.
I had 5,800. That's my ending inventory and the value. So if I didn't have 5,800, but I had 12,000 available, what happened to the difference? Where'd they go?
Sold.
I must have sold them. So this becomes my cost of goods sold, which I'm going to abbreviate as cost of goods sold. You're going to see me see this COGS. That's too long to write. Okay. So that's how you do FIFO. That's all FIFO is. And when you get to the end of the period, what you've got to determine are two things. What value do I put on my balance sheet to show what my ending inventory number is? And what do I show on my income statement as my cost of goods sold? Okay? So that's FIFO. Pretty straightforward.
You made it so much simpler than the book.
Let's talk about LIFO. Well, LIFO, we're going to do the same thing. We have 450 units, but now when we say LIFO, the last ones in were the first ones we sold, which means the ones we have left are what? If we sold the last ones, the ones we have left in the inventory must be the first ones.
Yeah.
So we're going to go over here, we're going to say, okay, we're going to start with the January 1st. And we had 100 there at $10. So that's 1,000. So that's 100 of the 450, but we still need some more, don't we?
Yep.
So we come down here, well, oh, there's 200. So let's take those 200. That's April 15th. 200 at 11. And that's going to be 2,200. But that's still not enough. 100 and 200, that's only 300. We need 450. We need another 150, right? Well, look, we can get all 150 we need out of this layer. So that's the $12. So we need another 150 at $12. And that's going to come from the August 24th. 24th. So if we multiply that out, what is that? 6? Oh, I don't have my sheet. 6,000? 5,200?
6,200.
5,200.
6,200.
It is?
No,
Oh, I'm sorry. 3,000 for that total.
150? It should be half of 3,600.
I'm looking at the wrong one.
It's what is it? 1,800.
1,800. There we go.
1,800.
Oh, I'm sorry.
Doing my math.
Total.
It's late in the day.
Sorry.
It's 1,800. So this is going to give me my 100 plus, I can do this math, 100, 200, that's my 450 units, so I'm good there, okay? And then over here I add this up, and that's going to give me, hopefully, 5,000? It's like 5,000.
Yeah.
So that's my ending inventory. Now I'm going to use that to go through and again do my cost of goods sold. So I do my goods available for sale. That's the same number. I always had $12,000 available for sale during the period. That doesn't change. So I have $12,000. But now I'm going to say that my ending inventory was the 5,000. I subtract the ending inventory because I still have that. So the difference between what I had available and what I still had at the end must have been what I sold. And that's the 7,000. And that becomes my cost of goods sold. Now notice something here about FIFO and LIFO. Prices are going up, right? Going up from $10, $13. We're in a period of rising prices. If you use LIFO, your cost of goods sold is higher than FIFO. Why is that? With LIFO, what are we selling?
The higher.
The last ones, the more expensive ones. With FIFO, we're selling the early ones, the cheaper ones. And that's one of the reasons companies use LIFO, is because by using LIFO in a period of rising prices, they're able to show a lower or a higher cost of goods sold. And if you have a higher cost of goods sold expense, what does that do for your income?
Higher.
If your expenses are higher, your income is going to be lower. So if you want to show a lower income, you would use LIFO. Why would you want to show low income if you were a manager? Taxes. There you go.
It's all about taxes.
It's the taxes. Could I use FIFO? FIFO is going to show, FIFO, right? FIFO is going to show you a higher net income number, and it's also going to show a higher balance in your inventory. Notice this inventory balance at the end, 5,800, is higher than the LIFO ending inventory. So if I want to show high income and high assets on my balance sheet, I'm going to like FIFO. That's going to make me happy. It's going to make these stockholders and investors happy, right? It's going to make the bank happy. But if I want to minimize my taxes so I don't pay income, I'm going to use the cost of goods sold here because that's going to give me a lower income. It's also going to give me a lower valuation for my inventory, and if I have to pay property taxes like a lot of companies do on their inventory, I'm going to pay less property taxes. So I'm going to save property taxes and income taxes using LIFO.
And you can switch from each other per year?
No.
No, you can't, because that would be too easy. No, once you pick a method, you got to stick with it. But hey, how about if we do this? How about if we use FIFO for our GAAP statement, income statement, balance sheets, and everything for our financial statements, but we use LIFO for our income tax return? We get the best of both worlds, right?
Can you do that?
Cannot do that.
You can't do that.
I didn't think so.
You can't do that. The IRS says you can use LIFO for your income tax return, but you have to be using it for your income statement as well, for your financial statements. So whatever method you use, you have to be consistent on both your tax return and on your GAAP financial statements, because otherwise it leads itself way too much manipulation. Okay. So I just wanted to illustrate that because we're going to talk about that later on, but if you can see the numbers, it's a lot easier to get the concepts out. Now, this is LIFO and FIFO. The happy medium in between the two is the one I don't have room for now. That's the average cost, right?
Yep.
Average cost is over on page 268. Where is it? I'm losing my sheets here. Yep, 268. So average cost is just what it says. We're going to basically go through and we're just going to figure out what our average cost is. So average cost. So what we do there is we go through and we're going to take all the goods we had available. In other words, all the amounts we had to sell. So how many did we have available to sell?
1,000.
We had 1,000 units, and how much did we pay for those?
$12.
$12 or 12,000. So what we're going to do is we're going to take our total goods available for sale and divide it by our total units available for sale. So in this case, we had $12,000 that we had spent. Okay, that was our dollars, 12,000, and then we had 1,000 units. So that works out to be $12 a unit. That's pretty straightforward. Okay. Now we're going to use that to go back and apply against what we had. We had 450 units in any inventory, right? So if we have 450 units times $12, what does that give us? Where's my numbers? Our in inventory works out to be $5,400. Okay? That wasn't too hard. And then how do you think I find my cost of goods sold? Same calculation. I take my goods available for sale, which was $12,000, and I subtract my ending inventory. It's hard to write at this angle. That was $5,400, and that's going to give me my cost of goods sold, which is $6,600. And if you notice, that's right in between my FIFO and my LIFO. Average cost splits the difference between them. Same thing on my ending balance. My ending inventory at $5,400. It's right between my $5,000 LIFO ending balance for inventory and my $5,800 for my FIFO ending balance for inventory.
Okay, so now can you add some sales in the middle of those and show us how to get
Yeah,
the goods
that was the
available for sale?
nightmare.
Well, the sales is when you do perpetual. On periodic, you don't care about sales. Because remember, on periodic, what you're doing is you're not going through and recording the sales until the end of the period. Here you're trying to find what your balance is at the end of the period. So your cost of goods sold is basically calculated at the end of the period. So when you're doing periodic inventory, you don't worry about sales. You're thinking perpetual. We're going to do that. That's harder.
That's what
Yeah,
I
that's
couldn't
a
figure it
lot
out because
harder.
I kept looking at the periodic example to
Ah.
figure out the perpetual.
Yeah, don't look at the
problem.
periodic example to solve the perpetual
think
problem.
so
That will lead to
stupid.
perpetual frustrations, what that will lead to.
That
Okay.
would be to almost throwing your computer out the window.
Yeah, so yeah, that's why this is all based upon what happened in the period. We do it all at the end. So it doesn't keep track
Is
of what's
there-
happening during the
In the
period.
book, is there a perpetual average of cost examples?
There is. We're going to do that. It's on page, perpetual average cost is over on page 279. We're going to do one of those. So you're going to need to do these. You're going to need to know how to set these up and go through and calculate the ending inventory amount and the cost of goods sold for the periodic inventory system for FIFO, LIFO, and average cost. You're going to need to know how to do that. Okay?
For the periodic?
For periodic, you're going to have to do that. Okay.
Okay.
So, what else can I tell you about periodic? Okay, that's probably all about periodic. So let's go
This is
to,
the lamb.
let's go, huh?
This is the lamb.
The lamb, yeah, this is the lamb. This is the easy one. Now let's go to something that's a little bit more challenging. Now that we're getting a little bit later into the class time period here. Perpetual, again, we have to keep track on the perpetual basis of every transaction after every inventory. Here, you notice we're not recording. Remember, on periodic, when we had a sale, we didn't do anything with our inventory. No entry in inventory, so we didn't have to come up with a value. We just waited till the end and used this to find our value for our cost of goods sold for the whole period. But when we're doing perpetual, every time we sell something, we got to do a credit to inventory. Well, we got to know what the value is. That's what we have to do with the perpetual. So let's go to that. Any more questions on the periodic? Okay.
But do you have a better equation than the system does?
The better equation for periodic?
Yeah,
What do you mean the equation?
because it was a ridiculous equation. The example they gave, it was like add this plus this minus this, then divide it by add this plus this minus this.
Was this for the perpetual or periodic?
Yeah, the perpetual.
Oh, well, we'll go through that. No, there's really there's really no shortcut. You just got to think in terms of layers. That's the problem. So when we go through it, again, walking through it sequentially, hopefully that'll kind of explain a little bit. And in perpetual, you do take into account the timing, the dates of the sales, because unlike the periodic where you just do everything at the end of the month, here you are going through and trying to figure out how you are accounting for things, and the chronologically is important. So over on page 277 is where they start with the details for the perpetual. And so I want to write up here again so we kind of have it for reference. The transactions that happen on the bottom of page 277. Yeah, this is, make sure I got this. Yeah, this is it. So what's happening here is we're going through and we actually have, again, the date. And then we have the explanation of what happened. Try to write small because it's going to be, we're going to run out of space on this one. Units, unit cost, and then total cost. So what happened here was on January 1st we went through and we had beginning inventory. So we did our count. And we had 100 units, and they were $10, so that was $1,000. And then on 4/15, we had a purchase, and these should be the same as what we had on the periodic. We had 200 units we purchased, we paid $11, and so that was $2,200. And then we had on 8/24, we had another purchase. 300 units, so $12, $3,600 is what we paid for that. And then this is what's new. Now we go through and we actually put in when the sale occurred. This is a pretty slow business because you only had one sale during the year, but we'll work with that. So we had a sale. We sold a big sale. We're going to have only one sale a year, make it a big one. So we sold 550 units. Now we don't put a value on that because we don't know what the cost is. That's going to be what we're trying to figure out. And then we went through on the 27th, and we had another purchase, and we purchased 400 units, and we had $13 what we paid for each one of those, so that was $5,200. Okay. So again, what we had during the period that was available for sale was $12,000. So the only thing we've added that's different is we've added the date for the sale, because since it's perpetual, we need to know when the sale occurred because we need to make an adjustment when we have a sale. So let's go through and let's do the FIFO. FIFO perpetual. Now, the first thing you're going to need to do, we are going to have to keep track of things by date. So let's just put a date in there. Then what you're going to want to do is we actually have to keep track of the amounts by purchase and by cost of goods sold, because we're going through, when we do a purchase, we're recording transactions into inventory, and when we sell something, we're taking it out. So we're actually going to have a column here where we call purchases, and then we're going to have cost of goods sold, and we're actually going to have to compute these. And then now we have to keep a running balance, because perpetual, we always know what we have in there, so we're going to have over here a column called balance. So on January 1st, we started with our beginning inventory, right? So that was what we had, January 1st. We had 100 units, right? Or 100 units at $10, right? So we had 100 units at 10. So our balance was $1,000, right? That's the easy part. Then we came through on the 15th of April, and we did a purchase. So the purchase was pretty straightforward, okay? The purchase was 200 units at $11. Okay. So that was $2,200. So we debited inventory for $2,200, right? We didn't have anything that we sold. Now we come over here, what's our balance? Well, our balance is the 100 at 10 plus the 200 at 11. Which is 2,200. So the total is 3,200. So that's our ending balance. Then we keep going. Well, in August, we went through 8/24. We had another purchase. We had 300 at 12. That was $3,600. So we went through, we debited inventory on that date for $3,600, and we credited payables or cash. Okay. Now we come over and we say, well, what do we have in our balance? Well, we still have the 100 that we carried forward at 10. We have our 200 that we have at 11. But we also now have 300 at 12. So if we add those all up, that gives us 6,800. So that's what our ending inventory balance is. Okay. Now we come over here to September 10th, and that's where things start to get weird. Because we had a sale, and we sold 550 units. Now, which units did we sell? We're using FIFO. What does FIFO say?
First
out.
First in or the first out. So when we sold them, this is the cost of goods sold, we sold which ones? The first ones. We sold the first ones because we're doing cost of goods sold. So the first one we had here was 100, right? So we have 100. We sold at $10. So that's 1,000. But we have 550, so we have to go to the next level, okay? Actually, we're doing right here. Here's our 100. So then we go to our 200. That's at $11. That's 2,200, right? And then we go, okay, well, that's 300. We need another 250, right? Do we have 250 in here? We do, so we take 250 out of that layer of 300 at 12. What does that give us? Do the math. That's 12, 5. Is that 3,000? I hope so. And so that's going to give us a total of $6,200. So our cost of goods sold for that transaction was $6,200. So we're going to debit cost of goods sold, and we're going to credit inventory because it's out of the inventory. Now we come over here. I really needed more room, didn't I? All right. Now we're going to come over here, and we're going to find our ending inventory. Well, what do we have left in inventory? We sold the 100. We sold the 200. We only have 50 left at 12, right? So our ending inventory now is only going to be $600 at that time. So we're low, so we better buy some more. So we go over here, and on 11/27, we do some more purchases. We buy 400 at $13, which is 5,200. And then when we go over here and figure our ending inventory, now we still have the 50 that was left over at $12. But now we have the 400 at 13. 5,200. So now when we get to the end of the period, we add that up, we have $5,800 that's in our ending inventory, and then our cost of goods sold is just the $6,200. So we don't have to do any reconciliation because we've been doing these calculations as we went along. Now, if we'd had more than one sale, which is the way companies normally would do it, if we had more than one sale, we would have to keep doing this calculation. We would just add up all of the amounts that we had in our cost of goods sold to see what our cost of goods sold was for the whole year.
Can you go over the balance one more time in that sale?
The sale here? So how we get this 50? Is that what you want to know? Okay, this is what we had before. The numbers are kind of messed up, so I'm sorry about the order. But before, after we did the 824, we had 100 units at $10, 200 units at $11, and 300 units at $12. So we had $6,800. We sold 550 units. So since we're using FIFO, the first ones in were the ones we sold. So we sold the 100. We sold the 200. And we needed, after that, we needed another 250 to get to our 550, right? So I had to take 250 out of the 300. That means there were 50 of those left, and they were at the 12. So that's how I got the 600. Okay?
Can I ask a question?
Sure.
For the test, are you gonna let us bring more than a couple pieces of paper?
You can have as many blank scrap paper as you want. Yeah.
Can we have a tiny little note card with notes on it?
No. You can't have a tiny little note card with little notes on it. So,
Okay.
that's a lot of work, isn't it?
Yeah.
Okay? But does it make sense, the flow? All you're doing is every time you're basically creating a layer over here. And then when you get ready to sell something, you figure out how many you need and you take it off the layer that's existed from all the purchases you've carried forward. It's really all you're doing. The whole concept in perpetual is you create layers.
Okay, maybe where my problem was the average then.
The average might have been. Okay, we'll get to that.
Yeah.
Okay. So are we good on the FIFO? Because I want to do the LIFO one too. All right. So I'm going to erase this because clearly I can't squeeze this in. So we're going to go through. I'll leave the dates up. Those are the same. Probably the purchases were the same too, but that's okay. So now let's do LIFO, perpetual. So LIFO perpetual, see which one I have here. There we go. LIFO perpetual is the same thing. We started off with our balance. That's where I got in trouble. So let's just move over here and we'll have a big balance over here. So we have lots of room. We started off with a balance. We had 100 units at $10, and that was $1,000. So then we went through and we had our purchases. Okay, so our purchases were the same. I didn't have to erase all that at all, did I? So our purchases were 200 at 11. So that was 2,200. And we carried this over. 200 at 11 equals.
You have to do the.
Yeah, I got to do my layer, don't I? Get in a hurry. $100, 100 units at $10 equals 1,000. And then I bring my 200 over to create my next layer at 11. So that's 2,200. I add those all up. That works out to be 3,200. On the 24th, I have another purchase, 300 at 12. That's 3,600. And then so I'm going to come over here and create another layer. So I have my 100 at 10. I have my 200 at 11. And then now I have my 300 at 12. If I add those all up, that's $6,800. Okay. So pretty much it looks the same so far as what we had before. Now in September, that's where we had the issue because we had a sale. And so we sold 500 units, 550. So now we're using LIFO. And LIFO says what? Last ones in are the first ones out, right? So that means we're going to sell the last ones in. So what were the last ones in?
300.
The 300. So we're going to come over here, we're going to say, okay, well then we sold 300 at the 12. That's 3,600. But that's not enough, right? We need 550, so we go to the next layer. The next layer, well, 200, we're going to sell all of those, because that still doesn't get us to the 550. So that's the amount that we sell the 2,200. Now we've sold 500, we need another 50. We're going to take 50 out of this layer, the 10, right? So that's 500. So now when we add this all up, that's 7,036, 6,300. All right. And that's our 400 or 550 units that we sold. So that's our cost of goods sold. Now we come over here though, and what's left? Well, we sold all the 300, we sold all the 200, we sold 50 of the 100, so we only have 50 of the 100 left at $10. So our ending inventory is to $500. It's exactly like FIFO, the only difference is where you start. Okay, with FIFO, you start first ones out, you start at the top and work your way down. With LIFO, last ones, you start at the bottom and work your way up. It's the only difference. Okay? And then we go through and we add our purchases. 400 at $13. So that's $5,200. And now when we come over here and are in inventory, we're going to have two layers. We're going to have 50 at the $10 layer, and then we're going to have 400 at the $13 layer, which is $5,200. So our total inventory is going to be $5,700 at the end of the period. It's a lot of numbers.
Thank God software does this all.
Yeah, software does this for us. Thank goodness for accounting records, right? But you got to understand what it's doing, because if you ever have to go in and figure out what's going on, you're lost,
Yeah,
right?
I get it, yeah.
Now, you're going to probably have to do either a FIFO or a LIFO, perpetual calculation on the test.
Not an average?
I'm not going to have you do an average.
Oh, thank God.
God!
I want to show you the average, but I'm probably not going to have you do it. Okay, so you can relax, okay? I just want to make sure you understand the FIFO or LIFO. Okay, so let's do the average, because that is a challenging one. And that is one where the system does maintain it for you. Okay, any questions on the LIFO?
Don't erase it.
Huh?
So it's just gonna be a matter of writing it out.
You're writing it out still?
Writing it out of the test.
Hopefully the video's working. Is it still running?
And a little red light still blinking.
Yeah, that's a good sign. Is it blinking on the backside? You can see it off of here. Okay, all right. Hopefully, and then I can just figure out how to get it out of the machine and put it onto the computer. Okay, got it?
Yeah.
All right. Okay, so average cost on page 279 for the perpetual method. Average cost. All right. So the same thing applies. We're looking at our different dates. So we started on January 1st. So on I erased everything. Oh, okay. I can do that.
But is it different?
I don't know.
It is a little different. Purchases.
I don't know. Look at
Cost of goods sold, and then balance. Okay, so on January 1st, we still had the same amount. We had our 100 units at our $10. That didn't change. It's always good to reset back to the beginning. Then we went through on April 15th and we bought some. We purchased 200 units at $11. And that's $2,200. Now, here's where it gets a little strange.
Yeah, a little.
On the average cost method, what you have to do is every time you buy inventory, you have to calculate a new average cost. That's the whole purpose of it. So what we have to do is we basically have to come over here and we have to say, okay, we had 100, right? 100 at 10, and now we bought 200 at 11, right? Well, if I take that as 1,000, and I take that as 2,200, I now have, what is that, 3,200? And I have 300 units. So what I have to do is I have to divide that. I divide 3,200 by 300, and that works out to be $10.667. That's my average cost after that purchase.
You're making it into a lamb. The homework had 2 or 3 different sales.
Yeah, probably.
Yeah, purchase, sales, purchase.
Purchase,
sales.
yeah, they make you do it multiple times. So you have to keep recalculating this. You don't have to do it after a sale, but after every purchase you have to do a recalculation. So now we say, okay, we have 300 units, and our new cost is $10.667. So now what we end up with is a balance of $3,200. Now we come over here on 8/24. We buy another 300 units at $12. So that was $3,600. Well, because we did a new purchase, we need to find a new average. So we come over here, kind of do the same thing off the side. Well, what do we have? Well, we've got an average of 300 at $10.667, right? So what we end up doing is we have to go through and we have to find out what our new number is. So we're going to go through, see if I got my number here. Cost of goods sold, see where I got my numbers. 3,200.
This is why we need.
68 divided by 600 is my 11. I'm going to add up how much I had, okay? So I have 1,000. See if I can still do this, right? I have my 1,000 plus my 2,200, because I still, I'm sorry. My 1,000 plus my 2,200 plus my 3,600, right? And I'm going to divide that by how many units do I have now?
700.
I have 100, 200, that's 300, I have another 300, I have 600 units. So I have 600 units.
Okay.
So what I've done is I've taken everything I paid, my purchase, because I haven't sold anything yet, right? So I've taken all that I paid, I divide that out, and that's going to give me, what does that give me? 11.333. So now when I come up to find my inventory, I'm going to take the 600 units at $11.333, and that's going to give me my new inventory, which is $6,800. But the key is, it's $11.33 is basically my average.
This is not how the examples were showing us. You made it a lot easier.
Well,
A
good.
little different.
Okay.
It's very different.
Okay. So hopefully you get the same answer. This is the example I'm using right here. I'm using it right out of the book.
No,
on
I
page
got the right,
279.
I eventually got the
Okay.
right answer, but the equation was something.
Oh, the equation? Yeah, I know. I like
Ridiculous.
equations.
Won't be easier because we're keeping track of the balance and every date. We just add up the balance at that, let's say April 15,
Yeah.
3,200, and
Keep adding these?
yeah.
You
Yeah.
could.
And
You
divide
could.
it by the units.
Well,
and-
one of the reasons this works over here is because we haven't had a sale yet. Once we have a sale, we can't keep doing that.
Yeah.
I'll show you that in just a second. Let's actually show you that right now. Because now we go through and we have a sale. Because once we only get away with doing what I did here because we haven't had a sale yet.
So once you have a sale, you should subtract that from the
You
total.
do, but then you have to use going forward the average cost for the remaining items.
Which is going to be the last one.
Yeah, it's going to be, okay. So what we're going to do is we're going to go through and we had a sale. And again, the sale, cost of goods sold, is 550 units, right? That's how many we said we sold. But now the cost is going to be what?
11.
$11. So we're going to take that at the average cost of $11.3333, and so our cost of goods sold is going to be, let's do it down here, $6,233. So that's how I find my cost of goods sold. Now when I come over here, though, it gets to be a little tricky, because what I'm going to do here is I had 550, I sold out of the 600, I have 50 left, right? So what I'm going to do, my 50 left are going to be at the $11.33. So my ending balance is going to be $567. Now notice I didn't do a new average after the sale. I only do a new average calculation after purchase. When I do a sale, both the cost of goods sold and the ending inventory are calculated at the last remaining average.
And the work we had it went purchase, sale, purchase,
Yeah,
sale.
and made you do it each time.
Yeah.
And that's what we're going to do now, because now you had a sale. Now on the 27th, you have a purchase. So you have another purchase of 400 units at $13, which is $5,200. Okay. And now what we have to do is we come over here, we have to find out what our average is, right? Well, we're going to do it this way. We have to use now, for these 50, this average. Once we've had the sale, we forget about the 10, 7, 67, all that. We use this number here. So we're going to come over here, we're going to say we had 50 at $11.33. That was $567. And now we have the new ones, 400 at $13, which gives us 5,200. So the total cost that we've paid for those is 5,767, and we have 450 units. So what we do is we find a new average, and the new average is $12.816. So the equation here is the dollars that you spent, the dollars divided by the number of units to find the average. So this is our new average. So now when we come over here and we calculate, we have 450 units at $12.816. 816, and that gives us an ending balance of $5,767. And then that's the balance we're going to carry forward and use every time we come up with any sort of sale. We're going to pull that number out. So what you'd have to do after every sale, you have to go through and you have to see what your new balance is, and then when you do a purchase, you've got to recalculate your average. If we did another sale right after this, we'd use the 12.816.
And this is why computers were created.
This is why computers were created, yeah. It's a lot of work. Okay. So, no, I'm not going to ask you to do this one on the test. But does that help explain it?
I understand the process.
Okay,
It was the
good.
math that was getting me.
Okay, all right. Does that help you guys? You were just happy when you heard that it wasn't going to be on the test, right? I would be too. Okay.
You're happy you don't have to grade it.
Huh?
You're happy you don't
I don't have to grade it. That's not a small part of the consideration. I think about what you need to learn. I don't want to make your brains explode, so I want you to learn something that has value and you'll actually retain, but I also don't want to make my life more difficult than it has to be. So we have a mutually agreeable goal in this particular situation.
Win-win.
Win-win.
Yeah, win-win.
It's a win-win.
Yeah.
Okay. Now, that's a lot. The last two things we have are almost so small that they're going to seem easy comparatively speaking. That's the gross profit method and the retail method. All right.
Before you erase that, can you show me how to do the cost of good available for sale?
The cost of goods available for sale for which one? For here?
Yeah.
Well, the cost, this is always going to be your ending inventory number. You're not going to need to do your cost of goods available for sale. Did they ask for that in one of the problems?
The cookies creation that I haven't done yet.
That will be that.
That would be
Never
over here.
changed.
That's just
Yeah.
12,000.
It never changed.
Yeah, because the
Yeah,
available
You and
for
I are
sale
getting
during the
both
period.
get mixed up on the definitions.
So you just don't use, or you don't add any of the sales?
No, the sales, this was what was available during the year. So it's just what you purchased and what you started with. That was what was available.
Got it.
Yeah, that's it. Okay.
Okay.
I thought you were talking about something over here.
And I finally figured out why I'm having such problems reading it. Is that stupid thing in 9th grade? I took a speed reading class.
Reading too fast.
Yes.
Yeah, counting, you got to slow down.
You hit certain words.
Yeah.
And
Okay, so can I erase it now and do the
Yeah.
gross profit and the retail? All right, now, the reason we do these two methods, we've actually counted something. The idea is we've done a count and we know how many we have and we're trying to price it. The next two methods we're going to look at are estimates. And normally you wouldn't want to estimate, but what would be a situation where you might want to make an estimate?
when you're bidding a job.
Where you're doing you're bidding a job, okay, that's true. But when's another example when maybe you couldn't go to your records? I'll just tell you, because you're all tired, it's late. The gross profit method is often used where a company has gone through and they've had some sort of a casualty loss. So they've had a fire, and their inventory's been destroyed in the fire, but so is their accounting records, because their office was there. Their computer, they didn't have it backed up, they don't have any invoices, they don't have anything. So they've got to come up with some way of estimating their loss, either for writing off for tax purposes or for the insurance company. So the gross profit method is one of the ways that they can do that. And what it does is it focuses and looks at the relationship between your price that you sold things at and how much gross profit margin that you had built into that. And you can use your information that you had from your sales to back into what your inventory was. So they show this over on page 280 in the bottom of the page. And so it's pretty simple. You do two steps, okay? So this is the gross profit method of estimating. You start off with what your sales were. So here they tell you that your sales were $200,000. And you know that you typically have a profit margin built in of 30%. How do you know that? Because that's normally what your product is marked up, okay? Most businesses have kind of a general profit margin that's bid in.
Yeah.
Yeah, or an average or something like that. They have more than one product. So what we do is we go through and we subtract out, okay, the estimated gross margin. Now you have to know it's 30%, but you take the 200,000 of your sales times 30%, okay, and that must mean you marked your sales up about $60,000. So if we take that out, we've adjusted our sales, if you will, back to what we think our cost of goods sold was. Because remember, our cost of goods sold is the price we paid for the things we sold, and that had a markup on it. So this becomes our estimated cost of goods sold. And once we have that, then we can just go through and do our little cost of goods sold calculation that we talked about the last time. So we start with our beginning inventory, which was 40,000. We go through and we add in our purchases. That was 120. So that's our goods available for sale. So that was 160. And then if we think that we sold approximately 140, that was our estimated cost of goods sold. If we had 160,000 available and we think we sold 140, then we must estimate that our ending inventory must have been about 20,000. So that's our estimated ending inventory. And so we can use that to make a claim against the insurance company policy, or to use that as an amount to deduct for our tax return for the loss. Now, how would we know these things? How would we go through and know this stuff? Remember, our records burned up. Computer, everything. Well, the nice thing is the information you need you can probably get from other sources. Your sales, you can probably get that from your bank. You know, you have your deposits that have been going in, maybe credit card sales. So you can go back and ask other people, you know, what your sales were, assuming that you were, you know, actually depositing the money, you weren't breaking cash off the top and something like that. We're assuming you don't do that. So you get your sales from your bank or from your credit card company. The margin you just know, and if you're doing an estimate on this, the insurance company is going to know what your margin is, because they know roughly what the margins are for most business industries, so they can come up with what you think they think is a good number, if you've used a number that's reasonable. You started with your beginning inventory. That's just going to be the inventory the last time you counted it. Okay, so hopefully you've got that somewhere. Maybe, for example, you have to put that on your tax return. You always have to show in your tax return what your ending inventory was at the end of the year. You could go back to your tax return and get a copy from the IRS and use that as your beginning inventory number. Or if you filed financial statements with a bank or some credit agency, you could ask them, what did we report for our beginning inventory?
Or you send your taxes to your CPA and he can get.
Or he can do that. So you get that from some source there. The purchases, where would we get the purchases? You just call your vendors and say, our record's burned up, can you tell us how much we bought since we last did inventory on this date, and you see what your purchases are. So you can get all this information from an outside source. That's why it's a good source for trying to figure out how you're calculating your ending inventory. Okay. So that's the gross profit method. It's pretty easy. Questions on that one?
Back-ended, just like you said.
So let's do the retail method, okay? Now, the retail method has a couple of advantages. They don't talk about this in the book, but there's a couple of advantages over the gross profit. First off, the gross profit is not allowable for financial statement purposes. Okay, you can't use that. But the retail method is, and the reason you do is because maybe you want to go through and you only do your inventory once a year, but you want to do monthly or quarterly financial statements. How do you know what your inventory is if you're doing periodic? Okay. So that's why you would use the retail method. The retail method is allowable for both tax and financial statement purposes as an allowable estimate, as long as you disclose that's what you're using. This you couldn't use for financial statements. You can only use this for an insurance claim, something like that.
That's a last resort.
It's a last resort. So the retail is a little better, and it gets used more often for that reason. Companies use it to do their interim financial statements if they don't want to count their inventory. So the basic idea behind that is you're going to keep track of some things at two levels. You're going to have it at cost and then at retail. And we're going to look at the relationship, just like we did with the gross profit, where we're going to look at the items and see what your gross profit margin is. Here we're going to look at the relationship between your cost and your retail. We're basically factoring in your gross margin as well.
What page is that?
This is on page 281. So we start with our beginning inventory. So we need to know what our beginning inventory is at both cost and retail. So they give this to us, but we would have this information because it was from our last inventory. In this case, remember, our records didn't burn up, hopefully. So obviously we've marked up our inventory. This is what we paid for it. that's what we're gonna sell it for. So that has our markup in that, okay? And then we go through and we have our goods that are purchased. And again, we know what we paid for them, $61,000, but we also know what we marked them up because we know we usually have a set markup on those items. So the cost or the retail of those was marked up to $78. Then what we do is we just simply add these together to come up with what our comparison is going to be. So we think we spent $75,000 at cost for beginning inventory and purchases, and this is $100,000. Now what we're going to do is we're going to simply calculate a cost to retail ratio using these two numbers. So we take our cost number, 75,000, divided by our retail, 100,000, and that's going to give a ratio of 75% or 0.75. We're going to use that in just a second here. Now, this is what we had. I guess this would have been, I didn't do this, goods available. So this is our goods available at cost, goods available for sale at retail. We didn't have all those at the end though because we sold some stuff, right? So we're going to subtract our net sales, which was 70,000. So that must have been that our ending inventory at retail was how much? The difference, 30,000. So that's our ending inventory at retail. But we can't put retail inventory prices on our balance sheet as inventory, right? We have to adjust it to our cost. So what we do is, well, what was our cost factor? 75%. So then we're going to take the 30,000 times 75%, 0.75, and that's going to be 22,500. That's our estimated ending inventory at cost. So that's the number that we end up putting on our balance sheet. And that's the number we use to find our cost of goods sold. So that's the retail method.
And the 30,000 is good for the income statement?
No, this is at retail. The
Okay.
22,500 is our cost. This is what we use.
Okay.
So this is what we're going to put over on our balance sheet as our inventory asset. And then when we do our cost of goods sold and we subtract our ending inventory to find the cost of goods sold, we're going to use this number.
Okay.
Okay. This is just what we think. You could go out and do this. You could just go out and count your inventory and see what the price tags say, right? Some people do that. They just go through and say, what's in the store at the end of the day? You run through, you have everybody add everything up in your price tag, and that's your number, and then you can apply your ratio. So you could do it that way too. Okay? Questions on that? That one's easy, right? You can probably expect to see a calculation where you have to do retail inventory and gross profit. Pretty straightforward calculations, but probably expect to see some calculations on those. Whew. I don't know, which one was harder, 5 or 6? 6? Okay. Well, we're done. We're done with 6.